The development of the inflation. Foreign lending. The first inflationary spurt, in late 1921 and early 1922, the beginning of the boom, was led by Federal Reserve purchases of government securities. Premeditated or not, the effect was welcome. Inflation was promoted by a desire to speed recovery from the 1920 to 1921 recession. In July 1921, the Federal Reserve announced that it would extend further credits for harvesting and agricultural marketing up to whatever amounts were legitimately required. Soon, Secretary Mellon was privately proposing that business be further stimulated by cheap money. Another motive for inflation was one we shall see recurring as a constant and crucial factor in the 1920s, a desire to help foreign governments and American exporters, particularly farmers. The process worked as follows. Inflation and cheap credit in the United States stimulated the floating of foreign loans in the U.S. One of Benjamin Strong's major motives for open market purchases in 1921 to 1922 was to stimulate foreign lending. Inflation also helped to check the inflow of gold from Europe and abroad, an inflow caused by the fiat money inflation policies of foreign countries, which drove away gold by raising prices and lowering interest rates. Artificial stimulation of foreign lending in the U.S. also helped increase or sustain foreign demand for American farm exports. The first great boom in foreign borrowing therefore coincided with the Federal Reserve inflation of latter 1921 and early 1922. The fall in bond yields during this period stimulated a surge in foreign lending, U.S. government yields falling from 5.27% in June 1921 to 4.24% in June 1922. Corporate bonds fell from 7.27% to 5.92% in the same period. The 1921 to 1922 inflation, in sum, was promoted in order to relieve the recession, stimulate production and business activity, and aid the farmers and the foreign loan market. Increased protection against European manufactured goods delivered a blow to European industry, and also served to keep European demand for American exports below what it would have been without governmental interference. To supply foreign countries with the dollars needed to purchase American exports, the United States government decided, not sensibly, to lower tariffs, but instead to promote cheap money at home, thus stimulating foreign borrowing and checking the gold inflow from abroad. Consequently, the resumption of American inflation on a grand scale in 1924 set off a foreign lending boom, which reached a peak in mid-1928. It also established American trade, not on a solid foundation of reciprocal and productive exchange, but on a feverish promotion of loans, later revealed to be unsound. Foreign countries were hampered in trying to sell their goods to the United States, but were encouraged to borrow dollars. But afterward, they could not sell goods to repay. They could only try to borrow more at an accelerated pace to repay the loans. Thus, in an indirect but nonetheless clear manner, American protectionist policy must shoulder some of the responsibility for our inflationist policy of the 1920s. Who benefited and who was injured by the policy of protection come inflation as against the rational alternative of free trade and hard money? Certainly the bulk of the American population was injured, both as consumers of imports and as victims of inflation and poor foreign credit and later depression. Benefited were the industries protected by the tariff, the export industries uneconomically subsidized by foreign loans, and the investment bankers who floated the foreign bonds at handsome commissions. The Republican administration, often wrongly considered to be a laissez-faire government, actually intervened actively in foreign lending throughout the 1920s. Foreign loans had been rare in the United States before the World War. On May 25, 1921, President Harding and his cabinet held a conference with several American investment bankers. The cabinet discussed the problem of favoring exports and the desirability of the application of the proceeds of foreign loans made in our own financial markets for the purpose of exporting our commodities. In short, the cabinet wished that banks floating foreign loans provide that part of the proceeds be spent in the United States. And Herbert Hoover was so enthusiastic about subsidizing foreign loans that he commented that even bad loans helped American exports and thus provided a cheap form of relief and employment. Helping Britain. The Great Expansion of 1924 was designed not only to stimulate loans to foreign countries, but also to check their drains of gold to the United States. The drains arose primarily from the inflationary policies of the foreign countries. Great Britain, in particular, faced a grave economic problem. It was preparing to return to the gold standard at the pre-war par, the pound sterling equaling approximately $4.87. but this meant going back to gold at an exchange rate higher than the current free market rate. In short, Britain insisted on returning to gold at a valuation that was 10 to 20% higher than the going exchange rate, which reflected the results of war and post-war inflation. This meant that British prices would have had to decline by about 10 to 20% in order to remain competitive with foreign countries and to maintain her all-important export business. But no such decline occurred, primarily because unions did not permit wage rates to be lowered. Real wage rates rose, and chronic large-scale unemployment struck Great Britain. Credit was not allowed to contract, as was needed to bring about deflation. As a result, Great Britain tended to lose gold. Instead of repealing unemployment insurance, contracting credit, and/or going back to gold at a more realistic parity, Great Britain inflated her money supply to offset the loss of gold and turned to the United States for help. For if the United States government were to inflate American money, Great Britain would no longer lose gold to the United States. In short, the American public was nominated to suffer the burdens of inflation and subsequent collapse in order to maintain the British government and the British trade union movement in the style to which they insisted on becoming accustomed. The American government lost no time in rushing to the aid of Britain. The isolationism of U.S. foreign policy in the 1920s is almost wholly a myth, and nowhere is this more true than in economic and financial matters. The 1927 conference between the leading central bankers that led to the inflation of that year has become famous. Less well known is the fact that close collaboration between Benjamin Strong, governor of the Federal Reserve Bank of New York, and Montague Norman, head of the Bank of England, began much earlier. On Norman's appointment as governor during the war, Strong hastened to promise him his services. In 1920, Norman began taking annual trips to America to visit Strong, and Strong took periodic trips to visit Europe. All of these consultations were kept highly secret and were always camouflaged as visiting with friends, taking a vacation, and courtesy visits. The Bank of England gave Strong a desk and a private secretary for these occasions, as did the Bank of France and the German Reichsbank. These consultations were not reported to the Federal Reserve Board in Washington. Furthermore, the New York Bank and the Bank of England kept in close touch via weekly exchange of private cables. As the eminent French economist Charles Rist, who represented the Bank of France at some of the important intercentral bank conferences, has declared, "The idea of cooperation among the central banks of different countries to arrive at a common monetary policy was born rather soon after the war. Before then, this cooperation had only been exceptional and sporadic." In 1925, the year Britain returned to the gold standard, the United States helped greatly. As a direct measure, the New York Bank extended Britain a line of credit for gold of up to $200 million. At the same time, J.P. Morgan and Company authorized a similar credit of $100 million to the British government, a loan that would have been subsidized, if it had ever been used, by the Federal Reserve. Both loans were arranged by Strong and Norman in early January 1925, and were warmly approved by Secretary of Treasury Mellon, Governor Kissinger, and unanimously by the Federal Reserve Board. More insidious and damaging was aiding Britain by inflating in the U.S. The 1924 expansion in America was much more than coincidence with preparation for Britain's return to gold, for the pound sterling had fallen to $4.44 in mid-1922, and by mid-1924 was in even worse shape at $4.34. At that point, matters took a decisive turn. American prices began to rise due to the American inflation. In the foreign exchange markets, a return to gold at the old parity was anticipated. The sterling-dollar exchange appreciated from $4.34 to $4.78. In the spring of 1925, therefore, it was thought that the adjustment between sterling and gold prices was sufficiently close to warrant a resumption of gold payments at the old parity. That this result was brought about deliberately through credit expansion in America is clear from a letter from Strong to Mellon in the spring of 1924, outlining the necessity of raising American price levels relative to Great Britain's and of lowering American interest rates to enable Britain to return to gold. For higher American price levels would divert foreign trade balances from the United States to England, while lower interest rates would similarly divert capital balances. Lower interest rates, being a more immediate outcome of credit expansion, received more attention. Strong concluded this letter as follows: "The burden of this readjustment must fall more largely upon us than upon them, Great Britain. It will be difficult politically and socially for the British government and the Bank of England to face a price liquidation in England, in face of the fact that their trade is poor, and they have over 1 million unemployed people receiving government aid. It is clear that by late 1924, the foreign exchange market saw that the United States was inflating in order to help Britain, and, anticipating success, raised the pound nearly up to its pre-war par, an appreciation caused by governmental action rather than by the fundamental economic realities. The Federal Reserve certainly kept its part of the rather one-sided bargain. Whereas throughout 1922 and 1923 the interest rate on bills in New York had been above the rate in London, the Federal Reserve managed to push these rates below those of London by mid-1924. As a result, the gold inflow into the United States, of which about 40% had been coming from Great Britain, was checked for a time. As we have seen, U.S. lending abroad was also greatly stimulated, thus providing Europe with longer-term funds. Inflationary measures to aid foreign governments also spurred farm exports, since foreign countries could now expand their purchases of American farm products. Farm prices rose in the latter half of 1924, and the value of farm exports increased by over 20% from 1923 to 1924 to 1924 to 1925. In February 1922, Norman hailed the easy credit in America during the previous few months, and urged a further inflationary fall in interest rates to match the burgeoning credit expansion in Britain. At that time, Strong refused to inflate further, and Norman continued to pepper Strong during 1922 and 1923 with expressions of his displeasure at the American failure to expand credit. But in 1924, helped by the siren song of Britain's return to the gold standard, and by a mild recession at home, Strong capitulated, so much so that by October Norman was jauntily telling Strong, "You must continue with easy money and foreign loans, and we must hold on tight until we know what the policy of this country is to be." Thus, the close international central bank collaboration of the 1920s created a false era of seemingly sound prosperity, masking a dangerous worldwide inflation. The fountainhead and inspiration of the financial world of the 1920s was Great Britain. It was the British government that conceived the system of intercentral bank cooperation, and that persuaded the United States to follow its lead. Britain originated the policy as a means of, temporarily, evading its own economic dilemmas, yet proclaimed it in the name of humanitarian reconstruction. England, like the United States, also used cheap credit to lend widely to continental Europe, and thus promote its own flagging export market, hobbled by high costs imposed by excessive union wage rates. In addition, Great Britain persuaded other European countries to adopt the gold exchange standard instead of the full gold standard, in order to promote its own economic imperialism, i.e., to spur British exports to the continent by inducing other countries to return to gold at overvalued exchange rates. If other countries overvalued their currencies vis-à-vis sterling, then British exports would be bolstered. Britain showed little concern that exports from the continent would be correspondingly hampered. To his great credit, Dr. Hjalmar Schacht, in addition to opposing our profligate loans to local German governments, also sharply criticized the new model gold standard. Schacht vainly called for a return to the true gold standard of old, with capital exports financed by genuine voluntary savings, and not by fiat bank credit. A caustic but trenchant view of the financial imperialism of Great Britain in the 1920s was expressed in the following entry in the diary of Émile Moreau, governor of the Bank of France. England, having been the first European country to re-establish a stable and secure money, has used that advantage to establish a basis for putting Europe under a veritable financial domination. The Financial Committee of the League of Nations at Geneva has been the instrument of that policy. The method consists of forcing every country in monetary difficulty to subject itself to the committee at Geneva, which the British control. The remedies prescribed always involve the installation in the central bank of a foreign supervisor, who is British or designated by the Bank of England, and the deposit of a part of the reserve of the central bank at the Bank of England, which serves both to support the pound and to fortify British influence. To guarantee against possible failure, they are careful to secure the cooperation of the Federal Reserve Bank of New York. Moreover, they pass on to America the task of making some of the foreign loans if they seem too heavy, always retaining the political advantage of these operations. England is thus completely or partially entrenched in Austria, Hungary, Belgium, Norway, and Italy. She is in the process of entrenching herself in Greece and Portugal. The currencies of Europe will be divided into two classes, those of the first class, the dollar and the pound sterling, based on gold, and those of the second class, based on the pound and dollar, with a part of their gold reserves being held by the Bank of England and the Federal Reserve Bank of New York. The latter monies will have lost their independence. The motives for the American inflation of 1924, then, were to aid Great Britain, the farmers, and, in passing, the investment bankers, and finally to help re-elect the administration in the 1924 elections. President Coolidge's famous assurance to the country about low discount rates typified the political end in view. And certainly the inflation was spurred by the existence of a mild recession in 1923 to 1924, during which time the economy was trying to adjust to the previous inflation of 1922. At first, the 1924 expansion accomplished what it had intended. Gold inflow into the United States was replaced by a gold drain, American prices rose, foreign lending was stimulated, interest rates were lowered, and President Coolidge was triumphantly re-elected. Soon, however, with the exception of the last named, the effects of the expansion dissipated, and prices in America began to fall once more, gold flowed in heavily again, etc. Exports for farm and food products, which had reached a peak during 1925, also fell sharply in the following year. In sum, the American economy entered into another mild recession in the fall of 1926, continuing on into 1927. Britain was in particularly bad straits, addicted to cheap credit, yet suffering chronic unemployment and continual drains of gold. But Great Britain insisted on continuing its policy of cheap money and credit expansion. Britain's immediate problem stemmed directly from her insistence on continuing cheap money. The Bank of England had lowered its discount rate from 5% to 4.5% in April 1927, in a vain attempt to stimulate British industry. This further weakened the pound sterling, and Britain lost $11 million in gold during the next 2 months, and the Bank of France, in a strong creditor position, tried to redeem its sterling in gold. Instead of tightening credit and raising interest rates sharply to meet this gold drain, as canons of sound monetary policy dictated, Great Britain turned to its old partner in inflation, the Federal Reserve System. The stage was clearly set once more, according to the logic of the American and British money managers, for another great dose of credit expansion in the United States. Accordingly, Governor Montague Norman, the Mephistopheles of the inflation of the 1920s, conferred with Strong and Moreau of the Bank of France in Paris. He tried a variety of pressures during 1927 to dissuade the Bank of France from selling its sterling balances for gold, balances which, after all, were of little use to the French. Norman also tried to induce the French to do some inflating themselves, but Moreau was not a Benjamin Strong. Instead, he not only remained adamant, but urged Norman to allow Britain's loss of gold to tighten credit and raise interest rates in London, thus checking British purchase of francs. But Norman was committed to a cheap money policy. Strong, on the contrary, leaped to Britain's aid. Trying to bolster sterling, he used American gold to ease the gold premium in Britain, and also purchased some sterling bills to aid his ally. And furthermore, Strong and Norman organized the famous Inter-Central Bank Conference at New York in July 1927. The conference was held in camera, and included Norman, Strong, and representatives from the Bank of France and the German Reichsbank, Deputy Governor Charles Rist and Dr. Schacht, respectively. The conference was held at the Long Island estates of Undersecretary of the Treasury Ogden Mills and of Mrs. Ruth Pratt of the wealthy Standard Oil family. Norman and Strong tried mightily to induce Rist and Schacht to go along with the general four-country inflation, but the latter two vigorously declined. Schacht continued his determined opposition to inflation and artificially cheap money, and expressed his alarm at the inflationary trend. Rist demurred also, and both Rist and Schacht left for home. Rist agreed, however, to buy gold from New York instead of London, thus easing the pressure on England to redeem its obligations. The New York Reserve Bank, in turn, agreed to supply France with gold at a subsidized rate, as cheap as the cost of buying it from England, despite the higher transport costs. Remaining to weld their inflationary pact, Norman and Strong agreed to embark on a mighty inflationary push in the United States, lowering interest rates and expanding credit, an agreement which Rist maintains was concluded before the four-power conference had even begun. Strong had gaily told Rist that he was going to give a little coup de whiskey to the stock market. Strong also agreed to buy $60 million more of sterling from the Bank of England. The British press was delighted with this fruit of the fast Norman-Strong friendship, and flattered Strong fulsomely. As early as mid-1926, the influential London journal, The Banker, had said of Strong that no better friend of England existed, and praised the energy and skillfulness that he has given to the service of England. In response to the agreement, the Federal Reserve promptly launched a great burst of inflation and cheap credit in the latter half of 1927. The regional reserve banks were told by Strong that the new burst of cheap money was designed to help the farmers rather than England, and this was the reason proclaimed by the first bank to lower its discount rate, not New York but Kansas City. Perhaps the sharpest critic of the inflationary policies within the Coolidge administration was Secretary Hoover, who privately did his best to check the inflation from 1924 on, even going so far as to denounce Strong as a mental annex to Europe. Hoover was overruled by Strong, Coolidge, and Mellon, with Mellon denouncing Hoover's alarmism and interference. Mellon was Strong's staunchest supporter in the administration throughout the entire period. Unfortunately for later events, Hoover, like most of Strong's academic critics, attacked only stock market credit expansion rather than expansion per se. The reasons for Strong's devious and secret methods, as well as the motives for his inflationary policies, have been no better described than in a private memorandum by one of Strong's staff. In the spring of 1928, Strong firmly rejected the idea of an open formal conference of world central banks, and in the words of his assistant, he, Strong, was obliged to consider the viewpoint of the American public, which had decided to keep the country out of the League of Nations to avoid interferences by other nations in its domestic affairs, and which would be just as opposed to having the heads of its central banking system attend some conference or organization of the world banks of issue. To illustrate how dangerous the position might become in the future as a result of the decisions reached at the present time, and how inflamed public or political opinion might easily become when the results of past decisions become evident, Governor Strong cited the outcry against the speculative excesses now being indulged in on the New York market. He said that very few people indeed realized that we were now paying the penalty for the decision which was reached early in 1924 to help the rest of the world back to a sound financial and monetary basis. In short, in our supposed democracy, if the people were allowed to know what had been transacted in their name and what penalties they were subsequently being forced to pay, they would rise up in their wrath. Better to keep the people in ignorance. Strong himself, furthermore, did not realize how heavy a penalty the American public would be forced to pay in 1929. He died before the crisis came. After generating the 1927 inflation, the New York Federal Reserve Bank, for the next 2 years, bought heavily in prime commercial bills of foreign countries, bills endorsed by foreign central banks. The purpose was to bolster foreign currencies and to prevent an inflow of gold to the United States. The New York Bank frankly described its policy as follows. We sought to support exchanges by our purchases, and thereby not only prevent the withdrawal of further amounts of gold from Europe, but also, by improving the position of the foreign exchanges, to enhance or stabilize Europe's power to buy our exports. While the New York Reserve Bank was the main generator of inflation and cheap credit, the Treasury also did its part. As early as March 1927, Secretary Mellon assured everyone that an abundant supply of easy money was available. Again, the inflationary policy was temporarily successful in achieving its goals. Sterling was strengthened, the American gold inflow was sharply reversed, and gold flowed outward. Farm and food exports spurted upward, and foreign loans were stimulated to new heights, reaching a peak in mid-1928. But by the summer of 1928, the pound sterling was sagging again. Foreign lending slumped badly as both domestic and foreign funds poured into the booming American stock market. As a result, funds were attracted to the United States, and by mid-1928, gold began to flow in again from abroad. And by this time, England was back in its familiar mess, but now more aggravated than before. The crisis approaches. By now, the final phase of the great American boom was underway, led by the stock market. While a stock market loan is no more inflationary than any other type of business loan, it is equally inflationary, and therefore credit expansion in the stock market deserves censure in precisely the same way, and to the same extent, as any other quantity of inflated credit. Hence the mischievous inflationary effect of the 1927 statements by Coolidge and Mellon, who functioned as the copiadors of the bull market. We have also seen that the Federal Reserve Bank of New York effectively set the call rates for loans to the stock market in cooperation with the Money Committee of the New York Stock Exchange, its policy being to furnish any funds necessary to enable the banks to lend readily to the market. The bank, in short, used Wall Street banks to pour funds into the stock market. The call rate, as we have noted, stayed very far below its pre-war levels and peaks. Alarmed at the burgeoning boom, and at the stock prices that rose about 20% in the latter half of 1927, the Fed reversed its policy in the spring of 1928 and tried to halt the boom. A more stringent contraction by the Federal Reserve, one enforced, for example, by a penalty discount rate on reserve loans to banks, would have ended the boom and led to a far milder depression than the one we finally attained. At this point, true tragedy struck. On the point of conquering the boom, the FRS found itself hoisted by its own acceptance policy. Knowing that the Fed had pledged itself to buy all acceptances offered, the market increased its output of acceptances, and the Fed bought over $300 million of acceptances in the last half of 1928, thus feeding the boom once more. Reserves increased by $122 million, and the money supply increased by almost $1.9 billion to reach its virtual peak at the end of December 1928. At this time, total money supply had reached $73 billion, higher than at any time since the inflation had begun. Stock prices, which had actually declined by 5% from May to July, now really began to skyrocket, increasing by 20% from July to December. In the face of this appalling development, the Federal Reserve did nothing to neutralize its acceptance purchases. Whereas it had boldly raised rediscount rates from 3.5% at the beginning of 1928 to 5% in July, it stubbornly refused to raise the rediscount rate any further, and the rate remained constant until the end of the boom. As a result, discounts to banks increased slightly rather than declined. Furthermore, the Federal Reserve did not sell any of its more than $200 million stock of government securities. Instead, it bought a little on net balance in the latter half of 1928. The inflation of the 1920s was actually over by the end of 1928. The total money supply on December 31, 1928, was $73 billion. On June 29, 1929, it was $73.26 billion, a rise of only 0.7% per annum. Thus, the monetary inflation was virtually completed by the end of 1928. From that time onward, the money supply remained level, rising only negligibly. And therefore, from that time onward, a depression to adjust the economy was inevitable. Since few Americans were familiar with the Austrian theory of the trade cycle, few realized what was going to happen. A great economy does not react instantaneously to change. Time, therefore, had to elapse before the end of inflation could reveal the widespread malinvestments in the economy, before the capital goods industries showed themselves to be overextended, etc. The turning point occurred about July, and it was in July that the Great Depression began. The stock market had been the most buoyant of all the markets. This in conformity with the theory that the boom generates particular overexpansion in the capital goods industries, for the stock market is the market in the prices of titles to capital. Riding on the wave of optimism generated by the boom and credit expansion, the stock market took several months after July to awaken to the realities of the downturn in business activity. But the awakening was inevitable, and in October the stock market crash made everyone realize that depression had truly arrived.